Hey everyone, it's Jonathan Rose from Active Day Trader. Hope everybody's doing great. So let's talk about bonds. And for those of you who've never seen me talk about bonds, I'm going to look at them probably different than you're used to. So in front of you, I have what's called the ZB butterfly. So let me just show you real quick. If this is the yield curve, and we have the yield curve going out from 2-year, 5-year, there's 7-year, there's 10-year, all the way out 30-year, and there's ultra bond. Now, we can trade these different instruments, right? So there's the 2-year future, the ZT, the 5-year, the ZF, the 10-year is going to be the ZN, but the 10-year is really closer to a 7-year. The 5-year is really closer to a 4-year if you're going to get, real technical about it. The 30-year is going to be the ZB. It's actually really like an 18-year. And then the ultra is 30 plus. When I trade bond futures, if I want to sell because I think rates are going higher, or maybe I want to buy because I think rates are going to go lower, I don't really want to speculate. I don't want to guess. So for me, and this is just how I was brought up trading bond futures, I traded at a professional firm from 2003 to 2010. We would trade the yield curve, and we would do that using relative value relationships. So what that means is, again, we plot the points on the yield curve, and right now the yield curve is really flattening. What that means is the 2-year and 30-year are getting closer and closer together. And it's flattening because the Fed's moving rates, but the Fed's raising short-term interest rates. The back-end rates really aren't moving very much. So as those front end go higher, the back end aren't really moving. The difference between the 2-year and 30-year is getting closer together. That's called a flattener. If they got further apart, that would be a steepener. So a steepener would be the yield curve steep. A flattener would be it's very, very flat. So 2s, 5s, 10s, 30s, ultra. When I'm trading these, I want to look at the relative relationship. So I'm going to look at the 30-year, how it compares to the 10-year, how it compares to the ultra. If I'm going to look at the 5-year, I'm going to look at the relative value. I'm going to look, is the 5-year expensive to the 2-year? Is it expensive to the 10-year? And then I'm going to back into a trade. So if you've never seen me do this before, I'm sure you're a little overwhelmed. I get that. I just want to show you that there's a different way of looking at things, because I see many presenting on bond futures and they're just presenting they want to buy or they want to sell just purely based upon technical analysis. And for me, that just doesn't feel like it's enough. So in front of you, I have the bond fly. And the bond fly is going to be the 10-year, the 30-year, and the ultra. 3 different instruments on this one chart. The 30-year is going to be the belly, and the wings are going to be the 10-year and the ultra. So all this chart is showing us is from December 15th to present day. Over here, the bond, the 30-year, was very inexpensive relative to the 10-year, relative to the ultra. When it got up here, it was relatively higher, right? Because the whole chart moved up. Got lower, cheaper, got higher, more expensive. So again, just my way of looking at it. Right now, based upon this chart, I'm going to determine that the ZB is expensive relative to its neighbors, the 10-year and the ultra. So what does that mean for us right now? Well, we have unemployment tomorrow. Unemployment, we could expect volatility, specifically in the rates. The rates are really going to move tomorrow. The rates always move when unemployment's released. It's just a big catalyst. So this is what I like to do. I think rates are going higher. So I'm going to want to sell some futures. I don't want to sell the 10-year because I know the 30-year is expensive relative to the 10-year based upon this chart. I don't want to sell the UB because I know the 30-year is expensive relative to the UB based upon this chart. So what I am going to do is I'm going to look for really good entry points and places to get short the 30-year, the ZB contract. So now I have just the ZB contract in front of you. Now, a trade that I like to do every single unemployment is last trade 152, 132nd. Unemployment's released at 7:30 a.m. tomorrow. I'm in Chicago, that's Central Time. Right before unemployment, if you look at the order book, everybody cancels their orders. There's not much liquidity in the overall market. But what I like to do is I like to work limit orders way up high. So a limit order, I might work a limit order at, say, 153, 30 seconds. Maybe work another limit order up to the top of this band here, 154. So what happens is, while everyone takes their orders out of the trading book because a big number is coming up, if somebody puts in a market order to buy, well, the only place they're going to buy is the limit orders that are still in the book. There's a good chance, maybe, we get filled on a really high level and it comes right back down. Now, the reason I like doing this is because a few reasons. One, I showed you the butterfly. I showed you why the 30 years expensive relative to the others. I'm also a big believer that once the Fed starts moving, rates are going to go higher across the board. So I'm comfortable saying that if the market trades up here, I'm willing to get short. Those are the reasons why I'm going to work limit orders going into the unemployment release. If I don't get filled, no harm, no foul. I didn't have any risk, right? I didn't get filled. And if I do get filled, those are levels that I'm comfortable selling. That's how I'm backing into it. It's a different way than you're used to looking at it. If you're interested in learning more, shoot me an email. Happy to help. Support@ActiveDayTrader. Hope you're great. Thanks, Jonathan Rose.